Welcome back. Well, South Korea's Kospi, the stock index in South Korea, has just put in its biggest daily loss ever. It fell 12% today as the war in Iran sparks sharp rises in oil prices and creates volatility and uncertainty in stock markets. We're joined by Simon French, Chief Economist at Panmure Liberum, the UK's largest independent investment bank. A very good morning to you. Thanks for joining us, Simon. So something like that is very significantly headline-grabbing.
Yes.
It fell sharply the day before. Why is Asia a bit more affected than the stock markets here?
Disruption to global trade. So while we focused a lot, I'm sure we'll come on to talk about the impact of oil through the Middle East, the Straits of Hormuz, there's a broader worry for Asian economies, very reliant in terms of their growth on exports, that this, if you like, puts more friction in the sort of gears of global trade, and those Asian economies that are heavily geared to that will be most adversely impacted. There's
also a point that some of these markets, South Korea in particular, had risen extraordinarily quickly in the days and weeks leading up. So when you have a change in risk sentiment,
yes,
it affects the ones that have risen the fastest most of all.
That's right. What market participants would call, sort of some element of covering your position. If you've made a lot of gains, and in the case of South Korean indexes, and indeed actually the UK FTSE, although it's fallen quite aggressively in the last few days, still up 5% this year. South Korean index much, much more than that. That has been the place to be. Actually, non-US equities has been the place to be. So if you start to challenge those consensus trades, and the consensus trade has been short the dollar, and short the US market, and suddenly that's your classic safe haven, then you get some quite big whipsaw moves.
Let's talk about the move in oil prices that we've seen so far. When you sort of assess the UK finances, the outlook here, what's the price level that you kind of have in mind that starts to really take effect to domestic forecasts for inflation and for growth?
So there's the oil story and there's the gas story, and the transmission mechanism is somewhat different between the two. In oil, in terms of internal combustion engine, the forecourt price of petrol, actually the transmission is 2 to 3 weeks. So we'll start to see the squeeze on disposable income if these levels persist for, by Easter, basically. The picture for gas, though, is slightly different. That is making the marginal price for electricity generation in the UK and feeds into the energy price cap. Now, the next move in the energy price cap for households is actually down. It's down about £115 on the 1st of April. But it's the 1st of July, where if we're looking at an impulse on consumer spending, on growth, and therefore perhaps calls for the government to intervene, it'll be July and into the second half of the year before we see that hitting households. So the government has time to think about this in terms of the transmission on energy costs for households. It probably has less time for forecourt prices that might impact the growth outlook for the UK.
And what about interest rates? I mean, we were talking earlier about this, but it doesn't look like we get a rate cut now on the 19th of March.
That's right.
What about after that?
Well, to some extent, if you can tell me where the oil price lands and the gas price lands, then I'll tell you what happens to rates. But look, being flippancy aside, I think the idea the market had that there was going to be a rate cut in March hinged on one vote, and that was the Governor, Andrew Bailey, flipping his vote from hold to cut. He's going to play for time. That's the market perception. But he's got another meeting at the back end of April, 30th of April, where perhaps that will be the point if energy prices return. But I think the issue is that almost whatever happens now, we're likely to see sort of upside risk to inflation. It's a reason for the Monetary Policy Committee to sit on their hands, and possibly the 2 to 3 cuts the market was pricing looks more like sort of 1 for the year as we stand here now.
And step back from it all, the extent to which the government has flexibility, if needs be, to step in and help people with their energy bills. Following yesterday's spring statement, a lot of the coverage, showing that there's been an improvement. Has it been a drastic improvement in the headroom? And how would the markets react if the government had to step in again for a sort of wild card, exogenous shock to find more money?
Well, 2 parts to the question. First of all, how much of that headroom improvement yesterday was the result of lower gilt yields, the cost of government borrowing, at the time that the OBR, the Office of Budget Responsibility, put together the forecast? More than half, actually, of that improved headroom as a result of lower gilt yields. Now, that's all evaporated. Those yields have moved. So if you did a mark-to-market assessment right now, you would see that headroom eliminated. Your second point in terms of how gilts would respond, I mean, to some extent, we would be going back in perhaps sort of slightly less extreme forms, to the mini budget in September 2022 when the UK government unveiled a very big bailout. Something on that scale, gilt markets would really reprice down, yields up. I don't think anybody's talking about that at this juncture, but I think what we're talking about is fatigue with endless bailouts, adding to total debt, adding to the amount of public spending that has to be devoted to debt servicing. That's the problem the gilt markets have to absorb.
And step back rating out of 10 for where we are with the spring statement yesterday and with Rachel Reeves doing it. Is it much improved compared to the reaction after the past statements?
Look, I'd say 8 out of 10 on the basis that if the job there was to not mess things up, not add to the uncertainty in what is a very uncertain world, job done. Why isn't it 9 or 10? Well, those growth forecasts, 1.5% average for the rest of the decade, that's pretty subdued, isn't it? It tells you that the sort of primary mission of the government in terms of promoting fast levels of growth is just not working.
Simon, great to see you as always. Thanks so much. Simon French from Panmure Liberum.